This video is a warning for variable rate mortgage holders because there's a high likelihood if you got your mortgage with a big bank that you have a mortgage that is a ticking time bomb, a variable rate mortgage that has a huge payment on its way as interest rates go up. Even though you think that your payment is going to remain the same for the next 5 years, you've got some pretty big surprises and some landmines coming up as interest rates start to rise. And that's what we're going to talk about in today's video, is exactly what you need to know about rising rates and your variable rate mortgage, because there's some things your banker probably didn't tell you. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget to register for our 25,000 subscriber giveaway, where we're going to give away $5,000. All you have to do is go to 360giveaway.ca, and you also get extra entries for following me on Instagram and sharing the contest on social media. So don't forget to do that. So today we're discussing variable interest rates and the ticking time bomb that is about to happen to many borrowers if interest rates continue to go up. And this is a huge problem because when we've been talking about variable rates for the last couple of years, we've been talking about variable and adjustable rate mortgages as though they are one and the same. And the reason why is because the prospects of higher interest rates just didn't seem like they were something that we had to really worry about. Now with interest rates rising, we are getting emails from banks telling us to warn our variable rate clients that they need to be paying attention to what's going on with their variable rate mortgage. And what's the difference between a variable rate mortgage and an adjustable rate mortgage? Well, it's really simple. A variable rate mortgage tends to have fixed payments where the interest rate may adjust, but the payment will remain the same. That's the type of mortgage that is the ticking time bomb. Adjustable rate mortgages, on the other hand, have a variable interest rate. However, the payments adjust as the interest rate adjusts, which is the type of variable that we've been putting most of our clients into. Now, if you've been watching this channel and you thought, hey, forget it, I'm not going to go to Mortgage 360, I'm just going to go to my bank and get whatever the best variable rate that they can offer me is, well, there's a really good chance that you ended up with a variable rate mortgage that has a fixed payment, and that is where the problem lies. So this week we got an email from one of our lenders, one of the big banks, that said, hey, you need to be aware of this because our variable rate mortgages, even though the payments don't change, the interest rates do. And the trigger rate, which is where the payments will change, is where you get to a point where your payment doesn't cover the interest costs. And here's the problem with that, is your payment won't change until you're no longer paying down any principal. But while interest rates are going up and you're paying less principal, your amortization is actually getting longer. And at the end of 5 years, when your mortgage comes up for renewal, you're going to have to renew into a payment that is at the contract amortization. So in other words, if you started with a 25-year mortgage and your mortgage comes up for renewal, you're going to have to renew at a 20-year amortization. That is the contract amortization. And that is where the problem lies, because that is where you will see a significant amount of payment shock because you have paid down significantly less principal than you were supposed to. And I'm going to use a $500,000 mortgage for this example. So in this case, if somebody were to get a $500,000 mortgage in June of 2021, they would have been paying about 1.25% on their variable rate mortgage. Now we're going to make a whole bunch of assumptions here, but let's just assume that interest rates end up going up to about 4%. And that leads us in a situation where we've been paying less principal than we should have. And at the end of 5 years, we end up in a scenario where we paid down $30,000 less principal than we would have if we had a proper adjustable rate mortgage. Well, the problem then becomes is the payment will go from about $1,900 up to about $2,700 at renewal. And that is a massive jump, and a jump that most variable rate holders aren't expecting. So the question is, what do you do to avoid that jump? And by the way, if you're a fixed rate borrower, you've probably been paying about $2,200 or $2,300 or $2,400. Your payment's probably going to go up to about $2,500, $2,600. So don't think that you're out of the woods here. But the big thing is, for a variable rate mortgage holder, you need to take action, and you need to take action now. And there's one of two things that you can do. The first thing you can do is you can start increasing your payment in line with higher interest rates in order to make sure that you continue to stay on track with your original amortization schedule. So in other words, you continue to maintain that 25-year amortization and you pay down the principal as you're supposed to. by increasing your payments, using that increase of payment option. There's a reason why most banks have 100% payment increases on their variable rate mortgages, and this is why. It's to allow you to increase your payments so you don't fall behind on the pay down of your mortgage. Now, here's the problem with that, is we know from finance, we know from general habits, we know from dieting that people know what they're supposed to do, but they in general won't do it even though they know that they're supposed to do it, right? We know we're not supposed to eat that giant tub of ice cream. We know that we're supposed to do 10,000 steps a day, and we have good intentions to do it, but we don't. And this is no different. Most variable rate mortgage holders who think that they're going to increase their payments are probably not going to do it. So then the second option, and this is the better option, is you need to take your variable rate mortgage and get it converted into an adjustable rate mortgage right now. Now, you probably can't do that with your big bank because your big bank probably doesn't have an adjustable rate product. So what that means is going into the broker channel, coming to a company like Mortgage 360 and having us take that variable rate mortgage and getting it flipped into an adjustable rate mortgage where the payments will increase gradually. And here's the big difference, is over time, every about 0.5% increase in interest rates on a $500,000 mortgage is going to increase your payments by about $70. So you're going to feel a little bit of an increase gradually over time, but it's going to be significantly better than going from $1,900 payments to $2,700 payments. And under the exact same scenario where you end up going up to a 4% interest rate, your payments at the end of the term will be renewing into about a $2,600 mortgage rather than a $2,700 or $2,800 mortgage. So there's a ton of reason to do this. The key thing here is automation in finance is everything. Automated savings and automated payment adjustments. You want to make sure that your mortgage payments are adjusting if you've got that variable rate. And if you want that done for you, go into the description below, click on the link to apply at Mortgage 360, and we will happily help you convert that variable rate mortgage that you got at your big bank into a proper adjustable rate mortgage. Don't find yourself 5 years from now having a payment that goes up by $600, $700, $800, $1,000. It's just not worth it. Let's get the mortgage set up properly now so you're in a situation where you know exactly what your payment's going to be and that you felt the increases gradually rather than basically being at the mercy of the lender and the mercy of interest rates and having this massive payment shock at the end of 5 years. By the way, in order to do this, it's likely going to cost you about a 3-month interest penalty. All the other costs associated with moving your mortgage from one lender to another are going to be picked up by the lender that you're moving to. So that is largely going to be taken care of. And a lot of the time we can capitalize the penalty into the mortgage. So in other words, you can move from one lender to another without having to worry about any out-of-pocket costs. But here's the big thing, is it is imperative that you make sure you have the right mortgage with the right options. And it's also imperative to make sure that you've got somebody watching out for you and making sure that if there's a bigger discount available somewhere down the road or an opportunity to lock in at a really good interest rate, that somebody's got your back. And that is going to be the major benefit that we are going to help you with, because anybody, a brand new banker, a brand new broker can save you 0.1, 0.2%, maybe lead you down that direction of getting a variable rate rather than adjustable rate. But the big savings of dealing with a really great mortgage broker and a really great mortgage company like Mortgage 360 is being able to take those big swings that save you $5,000, $10,000, $15,000, $20,000 down the road, or protect you from a major landmine and a major surprise like a payment that goes up by 50% overnight on your 5-year renewal. And by the way, if you're thinking about locking in, I'm going to link to the video about fixed versus variable in 2022 so that you can watch that video next in order to determine if variable and adjustable is still the right mortgage for you.